Hey everybody! All right, it's time for another weekly update on S&P 500 earnings and TSP and C Fund for everything that's going on there. I'm always focused particularly on S&P 500 earnings data and what that tells about because I get my price targets based on that, and give you guys updates on what to expect as well. Um, This is gonna be a pretty should be a relatively short one, and probably be the last one for a couple of weeks at least, if not more. We'll go over the data, and you'll get kind of an idea and understand why that is. So uh, anyway, let's cover some of this information for you guys, so you can get back about your way. And yeah, if you have questions, of course, don't hesitate to ask. All right. All right, guys. So let's start with the broader index data that is meant intended for the general group population. This is as of 27 August, which was yesterday, Friday. Current value of the S&P 500 now is at 4305. Basically, that's based only on trailing earnings data. For those of you guys who are interested in that information, this is about a 5-point increase from last week. Basically, it went down from 4305 to 4300, and now it's back up to 4305. Kind of hovering around right on that cusp of both. All right, and looking forward the next 4 quarters, everything else there has also gone up 5 to 10 points as well, as you can see. That current value is supposed to go up to 45.35 a quarter from now, and then up to 47.05, and then 47.95, and then 48.20. So particularly, it's like I mentioned here, this 3 and 4 quarters out area, it's only going to be up 30. No, actually about 25 points. So um, that's across the entire index. So it's going to be pretty flat earnings performance there when that comes, if things look like if it stays that way. So be ready. There will be at least a lull in earnings growth, and I would expect that probably see something likewise on the price performance as well. So don't. That's not necessarily a reason to be alarmed. It's just kind of a calm before the next step up, perhaps. 12-month price target is back at 50.80, up 5 points again from last week. Ideal trading range is up another 5 points as well. For those of you guys who are swing traders, particularly, this isn't quite as much of an interest to you buy and holders, but if you know where my ideal trading range is, and you'll know where to expect the price to kind of level off and not really go any higher. If it goes up higher, it start to question if the market's getting irrationally exuberant, or just not starting to put the carriage before the horse with the earnings, price versus earnings instead. All right, last week's updates. I talked about last week. Well, last week, of course, I was only expecting a +2 increase in the current value this week. But what the companies that reported this last week, actually did was a +8. So it's a small increase, but it's any kind of improvement is a good one. It's good to see, and we'll hopefully continue to see that the rest of the quarter. As of right now, got 479 companies reported, so only about 20 or so more to go between now and the end of the quarter. 94.9% of the index constituents have reported earnings now. Total effect on current value this quarter is at +500, which is very strong. And as you see here, it's +230 right now is what I'm expecting next quarter. And then +170, and then +90, and then +25. So it's really going to slow down there over the next few quarters. The next quarter out, though, should still be pretty healthy growth. It's just what's going to start coming in to replace this 4 quarters out when the next quarter round of earnings come through in October is what we're going to be mainly interested in. All right, so percentage of the companies in the index that have already reported, that have also reported positive earnings performance compared to last year, is 87.9%. As I've talked about in previous weeks, this is an extremely strong number. Very, very wide participation in the growth. All right, so moving on here, I got the next 4 weeks out. I got this coming week, 30 August to 3 September, got 9 companies expecting to report with +4 effect on current value. At least that's what I'm expecting. If we get more than that, great, but at least expect to get 4. All right, 6 through 10 September, only have 2 companies expecting to report. So, and there won't be any, not expecting any real effect on CV. So, and then 13 September through 17 September, only 1 company expecting to report that week with only a +1 effect on CV expected. So for that reason, we'll probably not do these reports the next 2 weekends because there's just nothing really going on there. It's just 3 companies total between the 2 weeks. It's not even worth my time. 20 through 24 September, though, when 9 more companies report with expectation of negative 0 effect, basically ever so slightly negative performance out of all of them combined. That'll probably be the week that I will next do one of these weekly reports. All right, so just so you guys have some kind of idea what's going on there. Total expected change to the current value over the next 4 weeks is only going to be +4 total. Not much at all there. So in other words, this earnings data is not going to change much. These price targets here are not going to change much at all over the next 3 weeks, or actually 4 weeks. So, and for that reason, I've talked recently also about how I expect that speculators and technical chart traders are going to mainly have control of the markets more than likely over the next month or so. When we start getting to the back end of the month of September, we might expect to see more of the speculative activities, kind of trying to either buy or sell their positions before the earnings actually start getting announced the next month. All right, total. Let's see, stocks versus bonds. The expected stock earnings yield is now at plus 11.96%. That's still decent, like I mentioned. It's only down 2 basis points from what it was last week. It's down nonetheless, and I do expect it to keep dropping, probably, possibly even into single digits by next month. But again, we'll see how things go. We want to see how these things trend, and if it starts to get down to 5% growth out of it or something, and don't expect much out of stock prices at that point in time, and then also it starts to get a little bit more of promotional material for bonds, because the stock yield, the bond yield is how I've come up with this recommended stock versus bond mix. Right now, as you see here, I got it at 90% stocks and 10% bonds, which is the same as it's been the last couple of weeks. It did drop down from 95% stocks, 5% bonds a few weeks ago. 10-year Treasury note yield did go back up from 126 to 131. So it's up a little bit. Let's see if it will continue to trend upward, though. And sooner or later, you're going to see these stock yields drop enough, and then possibly bond yields rise enough to where you might see this drop to 85% stocks or even 80% over the next month or so, month or two, whatever. That's what I anticipate could happen. It doesn't mean it will. Might still stay at 90% stocks, but if you guys want some diversification or want something that's at least market sensitive or sensitive to the current economic conditions, I might say, this information here is intended to help you out. And if you look in the main announcement post in the main group, you can also see what my suggestion is for that. It keeps that in consideration. 90% stocks, 10% bonds, and kind of gives you a go-to mix of CS and I for the stocks, and then GNF or whatever I think is possibly a good mix for that kind of a distribution. So if you're a little bit more risk averse, I do recommend going with that diversified distribution suggestion that you can find in the main announcement post. Hashtag main announcement in the main group. All right. So for those of you guys who are only caring about TSP and nothing else, I'm going to go ahead and let you go here. If you want to see how the top 100 stocks in the S&P 500 did last week and what's coming up next week, keep watching and we'll go over that. Okay, so last week we only had, we didn't have very many companies. I believe these were the only three here in the top 100 that reported last week. First one is going to be Salesforce.com. They were the largest of the three that reported. They had a $246 billion market cap. For those of you guys who don't know, market cap is basically just a measure of stock price versus how many shares are outstanding. And that's all that really amounts to. So the more shares that they have outstanding, for public trading, and the higher the price is, the higher the market cap goes. All right, so Salesforce, though, their earnings this last week were mildly higher than what they were last year, $1.48 versus $1.44 per share, which it's like I said, it's kind of mild. Trailing 12-month earnings are at 547 right now, and looking ahead, we got 464, 441, 420, and 383. This is double-digit decline in earnings performance. For that reason, I have this rated as a 1 or a strong sell. Now, it's a strong sell if you're a momentum trader, but if you like playing a contrarian kind of move where you don't want to take advantage of dollar cost averaging or something, start buying up shares of something while it's down and on its way down. This is actually one where you might be interested in buying into. But if you're a momentum trader right now, probably a good time to sell it more than anything. All right, also got Medtronic, MDT. They have a $179 billion market cap. They had a very strong earnings performance at $1.41 per share versus 62 cents last year. That's more than double what they did last year. That's very strong. And trailing 12-month earnings, they are at $5.22 per share right now. And that is expected to climb to $5.50, $5.62, $5.72, and $5.80 over the next 4 quarters. That's double-digit positive earnings performance expected. So if I see double digits, then it gets a 5 strong buy for me. Intuit, it's the same situation here. I'm actually mildly higher on the actual earnings performance, $1.97 per share versus $1.81 last year. Very kind of weak growth, I would say, but it's still growth nonetheless. But what's more important is what the outlook looks like over the next 4 quarters. Trailing 12-month is right now at 966, and over the next 4 quarters, it's supposed to go up to 973, 1055, 1212, and 1120. Even with, I'm projecting these earnings performance based on this 966 to the 1120. In reality, it's going to go up more to 1212, and then it looks like it's going to drop back down some. What's causing that is something that requires research. It could be something transitive, or it could be, it could be like an investment or something or whatnot. I'm just, this is just meant to be a screener only for you to do further research into whether these might be good or not good stocks for you to own in your regular stock portfolios. Okay, so this one here, Intuit, regardless of the fact that its 3-quarter ahead earnings are higher than the 4-quarter ahead, I still rate them a 5 because there's still earnings that have to come in. Once they realize themselves, then it might see some tapering, but might still see some more growth for at least for the short term. We will want to see next quarter if you are wanting to have shares of Intuit, or you already have them in your portfolio. See what these numbers start going to beyond 4 quarters out. I only look at 4 quarters because anything further out tends to be a little bit more unreliable, because there's a lot that can change economically between now and then, and any projections that might exist already are just not reliable enough to work with, so are not worth my time to look at. Okay, so my companies by rating. and market cap. Basically, the larger company would be up on the top. Well, not on the top, but the first company in the list would be the larger company. Like so, in this case, we got 2 5 ratings or strong buys. It's Medtronic and Intuit, and they're in that order in size. So Medtronic is larger than Intuit. That's why I have them in that order. And then a strong sell is Salesforce.com. So not looking too good there for Salesforce. But like I say, this is everybody has different reasons for making their own different trades, and it's a good idea for you to know if you're a momentum trader or a contrarian trader or investor, whichever. Um, and maybe pick stocks that are ideally suited for your particular strategy. Just because stock might be bad for your own strategy doesn't mean it's not that it's also bad for somebody else's strategy. So that's something else you might want to keep in mind. Okay, so looking ahead, top 100 reporting this coming week. The only one that is reporting this coming week is Broadcom, AVGO, and they report on Thursday. That's it. So, okay, so to summarize, not very much went on this week. There was a little bit of activity there, only 9 companies, but the next 2 weeks only going to be 2 and then 1 company. So for that reason, the next 2 weekends I will not be doing these updates. Really, just expect nothing. Kind of a status quo, I guess. So also the main announcement posts in both groups don't expect that those are going to change at all either, unless there's something else going on, like maybe Deb and or I make an interfund transfer, or Deb maybe changes her contribution allocation setting. Don't ask me about my own contribution allocations. I am separated. The CA setting, as I call it, is completely irrelevant to me. I can't. It does me no good because I cannot contribute to my account anymore. And that is sometimes a question I have gotten from people. Well, what do you do for your CA? But, well, I don't have CA setting. I don't really care. And there's so many different ways you can strategize the contribution. So, yeah, I try to stay away from that. Figure out what works best for your own needs, and then or what makes the most sense to you, and you'll probably be okay. All right, so that's all I have for this one. I will have other content coming as well. Naturally, we'll be posting something in the Swing Trader group specifically for basically S&P 500 chart data, or actually not S&P 500, but S&P futures, because that's what I tend to look more at. Because I can look at volume information, and futures market is open longer time of the day than regular markets. So I can get more data from the futures charts than I can out of the regular indexes. So that's why I tend to focus on that. And I'll let Dario and Mufasa and whoever else in the Swing Traders group worry about posting some of the other chart technical stuff for S&P 500 or Dow Jones U.S. Total Completion Index, or basically your CNS fund data. All right, so that's all I have. Thanks again, and we'll see you guys a few weeks from now. All right, peace. See you later.